Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. The stock market, technically in correction territory. There's a lot of stocks that are well beyond that from all-time highs, and Decker's Outdoor Corp, DECK, is one of those. The stock is down 42% year to date. They had their earnings call late January. The stock fell a bit after that, and then basically every day since then, outside of a day or two, they've been falling and falling and falling, getting to a spot where the valuation might start to get interesting pretty soon, if not already. I did a video on these guys maybe in September where I thought the valuation was a bit rich. And sometimes it's hard to look at stuff like that in a bull market and say, this is too expensive, because if you look at the performance prior to this fall, this was a stock that was just going up and up and up and up. It's still only down 24% in the past year, despite falling 42% year to date, because this stock was just soaring until it wasn't. Donald Trump came into power, new tariffs, new nonsense happening every single day, and the impact here could be negative. This is an American company. Do other countries hate America now? Who knows? Tariffs on China, which is where they produce a good portion of their shoes, so certainly that might impact their cost base. The uncertainty here is clear. It's just a question of whether or not the uncertainty has pushed this price down too much, because now you've got a company trading at a P ratio of 19x, trading in the 17 billion market cap range. And it's a company that's growing at a good clip. For 2025, their guidance is to grow at 15%. So you're getting a 5% plus yield on something that's growing at 15%, which even in this market is pretty solid. Obviously, the question is going to be, can they continue that? Can they maintain their margins? Or will a lot of this stuff that's happening right now really negatively impact their business? There were some questions during this earnings call, despite the fact that this earnings was very solid, around Hoka and whether or not they had to start discounting that brand more than they used to, because this was always a full price brand that was growing at a really good clip. And it still grew at 23% in Q3 2025, but there were some uncertainties around future growth potential. I think that's maybe not as huge an issue as people make it out to be. UGG brand, which is 60 to 65% of their sales, growing at 16%. During this earnings call, they talked about how inventories were running out in certain stores, and they probably could have done better if that wasn't the case. Hoka still growing at 23%, maybe 30% of their revenue. Obviously a solid brand that's on the up and up. And then you've got a couple of other brands, nothing really major. Also on top of that, you've got a balance sheet that's really solid. You've got a $17-18 billion market cap, but the enterprise value is about $2 billion less than that, because they have no real debt. They have $2.2 billion in cash. They are buying back shares, and obviously, as the stock price falls, those share buybacks become more and more valuable, which is good for long-term shareholders. Obviously, if you're a buyer in the $200 range, you're not very happy. But if you're looking at it now, you look at the potential for growth still being there. You're looking at a valuation that's in line with some of these companies that are growing in the low single digits. You've got companies out there trading at a 4% free cash flow yield that are growing at 1%. Then you've got Decker's over here growing at 15%, trading at a 5% free cash flow yield. Is this getting very interesting? Is this something that I should be looking at very closely? So let's take a look at the valuation now. Disclaimer, guys, this video is purely for informational and educational and entertainment purposes only. It is not investment advice. So we've got Decker's $17.7 billion market cap, no debt, a ton of cash, so a really good balance sheet, enterprise value of $15.7 billion. You got a free cash flow yield of 4.3 to 5.3%, depending on whether you're looking at 24 actuals or 25 estimates. Buybacks galore, especially in the last couple of years, talking about 300 to 400 million in buybacks per year. Not a lot of stock-based compensation, so not a lot of dilution there. Still have 600 million plus in active stock buybacks authorized as of the latest quarter, so hard to tell whether or not they already used a lot of that, or if they still have a lot of dry powder to buy at 117. They have $2 billion plus in cash, though, to acquire more shares if they need to. They also have that money if they want to acquire other businesses. They are a brand kind of conglomerate where they have two main brands, but they could acquire a third one. That's a big part of the puzzle that's not accounted for in any of these revenue assumptions. You've got growth that gets them to about 7.2 billion by 29. I'm a bit more conservative than that. Have 15% growth for 25, but down to 5% by 29. So about 6.5 billion by 29 in revenue. Margin is the tough one here. I have 15.2% in 25 up to 16.2% in 29. So some margin expansion. Hard to tell what that looks like in the next couple of years with all this tariff talk. They do make a bunch of their stuff in China. Some of it is in Vietnam and Indonesia, but you're probably going to be impacted negatively by tariffs. Whether or not they can control that well remains to be seen. We'll hear more on the Q4 earnings call. I think that's in May, but until then, you're kind of pricing things in blindly, unclear what the economy looks like for the Hoka and UGG customer, unclear what their margins look like. So I think that's one of the concerns that investors have, and that's been driving part of the sell-off. Still, I'll stick with this. I've got a buyback of about 15% of their free cash flow, reduces their shares by about 2 billion after stock-based compensation, leaves them with about 2.2 billion in excess free cash flow on top of the 2 billion pile they have right now. So if there is a recession or something like that, this company isn't going out of business. They have a really solid balance sheet. They'll still generate free cash flow. They were generating free cash flow when they had 1.9 billion in revenue. Good cost control, good margin maintenance across the board for this business, whether it's during a recession or not. I think they can generate free cash flow even if their revenue slows down or even turns negative if a recession were to happen. One of the things that worries me in this new Trump economy is that other countries aren't loving us. This is an American business. There's boycotts from Canada, boycotts from Europe. Not sure how big those are. It's very unclear how that's going to impact a lot of these businesses, whether it's Deckers or other businesses or retailers, travel businesses, etc. What the economy is going to look like 6 months from now. You never want to see that as an investor, and that's why the stock market has taken as big a dip as it is. It's not just, hey, there's tariffs, and that might be an uncertain thing. There's just a lot of talk being done by Trump that is making other countries just not like us very much, and that's not a good thing from a long-term perspective. So as you look at this company, it was just trading at 220 bucks, probably overpriced there. It's correcting to a more reasonable valuation, but it's also the uncertainty of what this business looks like even a year from now. Will people stop buying Hoka shoes because they're American? Will people stop buying Hoka shoes because they're $180 and people are struggling economically? Hard to tell. I think that's what we're pricing in as investors. I look at the valuation here. Again, this is a stock that's traded at 3% historically. I'm probably closer to 4 to 5% right now, 50% on 4%, 50% on 5%. If you want to play around with any of these numbers, hit file, make a copy. There will be a link to this file down below. I get an expected return of about 8% at today's price point. If I want a 10% target return, I get about $106, so about 8% below where it is today. If you look at the fair values, ranging anywhere from 3 to 6% free cash flow yields. You get anywhere from 81 bucks to $153. That's kind of your range for this company. It's difficult to say, well, you're giving us a range. What good is that? Well, this is a stock that's gone from 200 to 120 in 4 months. You're going to see a range in this type of market, in this type of economy. It's just, you have to be comfortable with that. You have to be comfortable with the business you're owning. I think this is a good business overall. They have two good brands. Hoka is solid. My wife loves those shoes. UGG is really solid, really popular right now. The other 2 or 3 brands they have, very small part of their business. You're essentially buying those two, and you're buying the management's potential to take other brands to something bigger. They bought Hoka in 2012, I think, for like $1 to $2 million. At the time, it was a $3 million a year revenue business. Now it's a massive part of this large corporation. Can they acquire other businesses and do the same within the next decade? They have the balance sheet to do so. If there is a bit of a recession, their earnings will probably take a hit. Their revenue growth will slow. The stock price will tank. That's just what happens in a recession. But the nice thing about this business is they have a nice balance sheet. They won't go out of business. I think they can still generate free cash flow through a recession. And on top of that, because of their balance sheet, one, they can buy back their own shares at really good valuations, but two, they can also acquire other companies that are maybe slightly distressed in the private markets. That is really what you're buying with this business, is the potential for future development of other brands beyond what they already have. The brands they already have are growing at a decent clip, but they can also do more with other brands, acquiring other brands, etc. Is the valuation really solid right now? I think it's fair. It's decent. It's nothing amazing. It's crazy to say that after a stock dropped 50%, but it just speaks to the overvaluation we saw in the market, the exuberance around the potential Trump economy, and now the reality of the real Trump economy not being as great as people thought for businesses. So you've got a 4 to 5% free cash flow yield. That's pretty decent when you compare it to, like, let's say Nike. Nike's probably trading around a 5% free cash flow yield, maybe slightly worse than that. But that brand is better than what you've got here. However, it's also shrinking at 10%. On the other end, you've got brands like On Running, probably trading close to a 2.5%, 3% free cash flow yield, if that. But that's growing in the 20% plus range. So slightly different businesses, slightly different scale businesses right now. But owning Deckers at 17 to 18 billion versus owning On Running at 14 billion. Which one's better? I think Deckers might be a more interesting valuation right now. However, then you compare it against something like CROX. CROX trading at a 12% free cash flow yield, also around a $4 billion a year revenue business, even better margins than Deckers, but only growing in the low single digits there. The concern about Deckers and their growth, a lot of their growth, if you go back over here, is international. International sales, 28% over here. Direct-to-consumer still growing at a good clip. So that's a good part of their business. Direct-to-consumer, bigger part of their business than wholesale, more margin there. However, international growth is growing a lot faster than domestic. And if international growth slows down because other countries hate us and they don't want to do business with American businesses, that's going to mean negative things for overall growth here and maybe a negative thing for their valuation. So as I look at something like this, with all of the uncertainty around margins, around growth, etc., I'd probably want a more conservative valuation here. So if I'm targeting a 15% target return, I get $85. If I want a 10% margin of safety from a 10% target return, I got $96. So I'm in that range. The other question becomes, do I want to own more consumer discretionary brands going into this economy? That's a tough one because, you could certainly be impacted very heavily on the negative side if we hit a recession, because consumer discretionary stuff is going to be hit pretty heavily. And if you look at the consumer right now, a lot of retailers have spoken how they are getting weaker. Now, that might not be the type of consumer that Deckers is attracting because you're selling $150 to $250 shoes. But if the consumer is getting weaker in general, that's going to flow over to discretionary expenses because you only have this pot of money to spend. And if that pot of money is being impacted by tariffs, by other expenses going up, and just generally a weaker economy due to layoffs and other things, discretionary expenses are going to be cut and stocks like this will suffer. But I think a company like Deckers can, in the long run, take advantage of that via acquisitions, via stock buybacks. It's just whether or not the stock price remains negatively impacted for a long period of time, and if you can wait that out. Because this is a stock during a recession could be trading still 50% lower than it is today. That's just a reality. That's something you have to be comfortable with. The upside is significant. If interest rates get cut, the economy continues to be solid. Despite that, this is a fair value in the $150 range at a 3% yield, a future value in the $250 range. So that's the upside. It's pretty decent upside, but the downside is you obviously have to weather a recession if one comes. You have to weather a weaker economic climate for a short to medium term period of time, and kind of hope that they do the right thing with the money that they have, whether it's stock buybacks, whether it's acquisitions, etc. And I think historically, management has done a good job with that. The returns have been really solid outside of the year-to-date returns, because if you go back to 5-year returns here, really awesome, right? This is what you're buying. You're buying the potential that in the next 5 years, they could do something with their business that gets them back to significant growth again. But you may have to sort of sit through a 1-2 year period of time where things just sort of suck for consumer discretionary stocks. And that's already begun because the stock is down 50%. But could it get worse? Sure. So am I a buyer here? No. Would I be a buyer here in the $85, $90 range. I think so, but it would be small nibbles to start, building a small position, and then eventually building it out to be a bigger position, because I really like this company. I like the management here. I like their balance sheet. I like their ability to do something with it if the economy takes a wrong turn or continues to take a wrong turn, and we actually see it in the results. Because right now it's all assumptions around things being worse in Q2, Q3, etc. We won't see that for Deckers until the next earnings release, which is May. So you're sort of buying things blindly and hoping that that looks pretty good. And for me, that's never a great strategy. I'd rather wait until I see what those earnings look like, because if those earnings look bad, you could see a pretty significant move to the negative, despite the fact that it's already been hit by 50%. Obviously, if the earnings look good, you'll see the reverse. But for me, consumer discretionary, more of a stay away unless the valuation gets super, super interesting. And it's not super, super interesting yet. If it starts trading at 7% free cash flow yield, would I be in here? For sure. But at 5%, it's just fair value. If I was already holding this, I'd probably just hold it. But if I want to add to a position as a conservative investor that prefers to be in cash right now, as I talked about in my last video, I'll link that down below. I'm more heavily in cash, still heavily invested. But if I'm going to buy anything in this market, it has to be a really awesome valuation. So if you think this is that, let me know down below and maybe I'll reconsider. But if you also have any other stocks that you feel like are getting very interesting, let me know down below, because I'd like to look at those. I don't have enough time to sort of search for these stocks during my free time, work, etc. Takes up a lot of my time. So leave a comment down below, like the video, subscribe, all of that good stuff. And as always, thanks for watching. Bye.